Alright, so in-class exercise number 1. Okay. So in our facts, the key was that we had a beginning of the year DTA for stock-based compensation of $50,000 times 40%, or $20,000, and then we had a beginning DTA for an NOL of $500,000, right? Bless you. So that is $200,000. Okay, so we started the year with DTAs of $220,000. Okay, that's important. If we don't start with the right balance, we're going to be all screwed up the longer we go on. Alright, we got that? Okay, so let's do our current calc now. Okay, so we got our opening DTAs. We're going to do our current. So we said that our PBT was 3.750 profit. Our meals and entertainment was $100,000, so we're going to take half of that. Okay, we're just going to do this in millions. Our bad debt reserve went up by $175,000. And then we had stock options. Okay, so I'm going to say it's stock option, the prior year expense. So the award for the prior year was exercised, and our deduction was 35, right? Okay, and then we had an award for the current year expensed, and that was 165. We got to add that back because it's not deductible yet. All right. We have an NOL for 500. So our taxable income should be 3,605. 40% of that is 1,442. That is our current, right? Okay. Alright, so we're going to credit our payable 1,442. We know we got to do that. Okay, so let's think about our deferreds. Okay, so what I would do with deferreds, I'll do it a little differently. I'm going to have 4 columns. On beginning of the year balance, current year change. I'm going to have a shortfall and an end of the year. Okay, so I have an NOL, SBC prior year, SBC current year, and then bad debt reserve. Okay, so at the beginning of the year I had 500 of NOL and 50 of stock compensation, right? So tax affected 220. Okay, during the current year, I used my NOL. I got a deduction of 35 for my stock compensation. I increased my DTA for 165 for my new award, and my bad debt reserve went up by 175. Right? Okay, so what's that? It's 340, 160, 195. if I did the math right. Okay. Shortfall. So in this row right here, my DTA is not gone, right? So here my NOL is gone. My ending deferred for this stock comp is 165. My ending deferred for bad debt is 175. But this deferred, it's got to go away. This has got to be 0 because the award's gone. So I have a shortfall of 15. Right? Shortfall being the APIC. Yes. So in total, my DTAs are going to change by 210, or 40% of 210 is 84. So my DTAs what did I do wrong here? So I had, oh, it's because I didn't tax affect this. Duh. Okay, so tax affected, that's 136. Okay. So my DTA started the year at 220. They ended the year at 136. That means they changed by 84. Okay? Of that change, we know that this is going to be to deferred provision. And this is going to be to APIC. Okay? Because we know our shortfall, we have pool. Smiley face. Okay. So, our deferred roll forward, we started at 220, we ended at 136. We can explain how we got there. So if we were thinking of a journal entry for this thing, we know we got to our credit our deferreds by 84. Our deferreds have to go down by 84. But part of that other side of the entry is going to be a debit to APIC for 40% of 15, or 6. Right? Because tax affected times 40% equals 6. That is in effect debit APIC, credit DTA. That's what that entry is. Okay? That's not running through our deferred expense like every other deferred. Alright? Okay. So now, if we were trying to do our tax accounts, or let's actually do a journal entry first. So we said credit payable 1442. Credit DTA 84. Debit APIC 6. Debit provision, this should be what falls out. So 1442 and 84 is 1526. 1526 minus the 6, it's 1520. Okay? If I did my rate rec, I would say 3750 at 40% would be 1500. My only perm was meals and entertainment of 50 at 40%. It's 20. So my rate rec is so easy, and I'm done. Okay, questions on that? All right, if you guys can do that, you're going to be in great shape. You just need to do it quick, because we're going to do lots of these on the exam. It's not like a one and done thing. Okay, we good? Okay, next topic. Like I said, tonight is all business. Okay, now, so we just did RSUs and NSOs. Okay, so now we're going to talk about ISOs and ESPPs. Okay, ISOs in the left column of the two to the right, and then ESPPs are on the right. Do we get a future employee deduction? The answer says no, but the real answer is maybe, but no by statute. We're not sure if we're going to get one, right? So I'm on slide 29. Oh, really? Oh. Okay, there's a reason for that. We're borrowing last year's slides because we couldn't find the PowerPoint version of this year's. Oh, the reason is because I added a bunch of blank pages to scribble out the solution for you guys. That's the only reason. So if I delete those slides, it'll go back to the page number. But we're also borrowing last year's slides. Okay, so future employer deduction, do we get one? It says no, but that just means no by statute. Maybe is the answer, but we can't be assured of it. Do you recognize a DTA when books expenses the awards? No, right? If books grants, you get granted an ISO or an ESPP, books expenses it, you don't treat it as a temporary difference because you don't know if you're going to get a deduction. So instead, you treat it as a perm item. Okay, so if books expenses $100 of ISOs, you're going to say that's non-deductible, I don't think I'm ever getting a deduction, it looks like fines and penalties. Okay? You see in that green box, if you have a disqualifying disposition, you do get a deduction later. And so we're going to talk about in a minute what that means for tax accounting. Okay? But for the moment, you can't set up a DTA, you can't anticipate a deduction, you can't book a provision benefit for the book expense. Okay. So this is the same example as case number 1 that we went through earlier. It's just instead of an NSO, it's an ISO. Okay? So, the numbers are the same so that it stays familiar to you. The value of the ISO is 30. Not the value of the stock, the value of the option. The value of the option is 30. The stock price is currently 40. So somebody thinks that the stock is going up to at least 70 during the term of the option. Otherwise, it wouldn't be worth 30. 40% tax rate, and then when the person exercises, the stock is worth 80. Okay? All right, so Tejal, so you had answered on case number 1 what the answer was. So what do we book in year 2007? 2007 is the year when the book expense is recognized for 30. What's the tax entry? Yeah, we don't do anything. Right? So even though there's 30 of expense in our PBT, there's not a tax entry. 30 of expense just shows up as 30 of net income. There's no tax provision benefit. Okay? All right, so Kuwait, don't look at your slides. So what happens in 2008? So in 2008, the stock is 80 bucks. The person exercises, they get a $40 deduction. So the person recognizes $40 as W-2 income. It's a disqualifying disposition. The company gets a $40 deduction. So what do we book? We didn't set up a DTA. We didn't cover this yet. It's not a fair question. Okay, here's what you do. So you don't have a DTA to reverse. You didn't set up a DTA in year 1. right? But you got a $16 deduction or a tax savings of $16. That is real, right? Taxes payable went down by 16. Okay, so here's kind of the twist on these statutory awards. In year 2, you get to book a provision benefit. You get to book a provision benefit equal to the benefit you would have booked in year 1 if you knew that award was going to throw off a deduction. So in year 1, when the expense was 30, if you knew you were going to get a deduction for that award, you would have booked a provision benefit of 12, 40% of 30. So the way the rules work is they say for these kind of awards, you can't do that in year 1, but if in year 2 you do get that deduction, you can book a good perm for the lesser of the tax savings or the benefit you would have booked in year 1 based on that book expense. So we're not booking a provision benefit for all 16, we're only booking a provision benefit for $30 times 40%. Okay, that's the maximum good perm. Okay, so see how in that blue box I say, quote, good perm? All that's doing is it's reversing the year 1 bad perm. Right? Because in year 1, we treated that 30 of book expense as permanently non-deductible. And in year 2, we're like, oh, that wasn't right. We did get a deduction for that 30. So we need to book a good perm for it. Okay? But because there's an excess, just like with case number 1, we book APIC for the excess. Okay, so year 1, bad perm, no tax entry, we can't deduct the expense. Year 2, good perm. The good perm is the amount of the deduction up to the book expense from the year 1 where we booked a bad perm. The good perm can never be bigger than the bad perm. Easy? You guys are all looking down, killing me. Okay, I'm going to assume silence means you've mastered that topic. Case 4. Okay, company grants an ISO. This looks exactly like case 2, same numbers, except instead of an NSO, it's an ISO. Company grants an ISO. The value of the option, not the value of the stock, value of the option is 25. Somebody's willing to pay 25 bucks for this option. The stock is $40, and later when the stock option is exercised, the stock is only $50. So the person has a $10 gain. Okay? ISO with a $10 gain, even though the book expense was $25. Okay? Ellie, what do we do in year 1? When books expenses to $25, how do we treat that? As in, it's a bad perm, right? It's treated as a deduction or a book expense that's non-deductible. Okay? Good. Okay, so Ellie, what do we do in year 2? Gotta stop putting the answers in the slides. No, go ahead. You're doing great. Go ahead. Yeah, we're going to do that. Huh. I was telling myself I got to stop putting the answers in the slides. You guys are like, just flip the page. All right. We're going to debit tax payable. We have to. We saved $10 of, well, we got a $10 deduction, which means we saved 4 of tax. Our payable has to go down by 4, right? We didn't set up a DTA in year 1. We didn't anticipate a deduction, so there's no DTA to flip. We can book a good perm for 4. right? Our good perm is the lesser of our deduction times 40% or our book expense, 25 times 40%. Right? So we book as a good perm the lesser of 4 or 10, which would be 4, right? That's what we do. Okay, so year 1, we treat it as a perm. We're like, you know what? We may never get a deduction. This thing is dead to us. Year 2, we miraculously get a deduction. For the benefit of the deduction, we reduce our payable. We record a good perm for the lesser of the deduction or the prior book expense, and any excess goes to APIC. Boom, done. Okay? What's that? I don't show an APIC in this case 4 because there's no excess. There would only be an excess. There would only be an APIC entry if, like in case 3, we had a deduction that exceeded our book expense previously. So in this example, case 4, our deduction was less than our book expense. Okay, so now we've done NSOs where the stock goes up past the book expense. We've done NSOs where the stock doesn't go up past the book expense. We've done ISOs where it goes past the book expense, ISOs where it doesn't go past the book expense. All 4 of those scenarios, you should be able to like quickly process through a provision. All 4, I think, are on the exam. Okay? Maybe all on the same problem. Right? Because the reality of this stuff is, like, how many employees does Oracle have? Like 8 trillion, right? So each person, if you took like the number of grants that like Kuwei's gotten in her career, like I don't know how long you worked at SanDisk, but you get a lot of grants. So, okay, let's pretend you're Larry Ellison and you're the CEO of Oracle. He gets grants, right? I think we know that. So he's getting grants all the time, right? Every year, here's a new grant. Next year, here's another grant, right? Win the America's Cup, how about a grant, right? So he's just getting grants all the time, and when he's exercising or vesting in his RSUs or whatever he gets, these things are happening like piece by piece, right? It's not like all of last year's awards suddenly were vested and they go away. It's not clean like that. So the amount of tracking that companies have to do on this, right? Think of all the employees that companies have, and all those employees have bunches of grants, right? I mean, I worked at Deloitte for 20 years. If I worked for a company and I was getting awards for 20 years, can you imagine like my stock report? It would be crazy, right? And I'd exercise 2 shares this day, 7 shares that day. You know, I would do it just to mess with people, just so it would be hard to track. You know? But that's what happens, right? You're like, oh gosh, this guy's got an ISO windfall. How do I do with that? Okay, next day, fine. He's got an NSO shortfall. I got to figure that one out. The tracking of this stuff is unbelievable, right? Because the volume. So, you know, just think of these big companies and how many employees they have, and the ability for a company to be able to know when to set up DTAs and then when to reverse them. Because you reverse DTAs, you do all these entries grant by grant, person by person. Right? This is not an aggregate thing. You don't just take all of Oracle and say, what was all of Oracle's deduction and all of Oracle's DTAs? It doesn't work that way. You know, you do Cindy, and then you do Veronica, and then you do Larry, and you do person by person. Right? You probably do it in that order, too. That's my guess. Okay? So you know, in the real world, people have automated systems that will capture all this information for them. But you need to take all 4 of those cases and be able to quickly look at the facts, process what the facts are, know if you set up a DTA or if you have shortfall windfalls, how to book them. Okay? So my suggestion would be go through those 4 cases over and over again. Make sure you understand quickly what the journal entries are to be able to process that. Okay, exercise 2. More problems, more fun. Off you go. Okay. So, problem 2. Okay, so we're going to show you the solution in Excel this time. And so, by the way, we're going to email you all the Excel solutions for all 4 class problems tonight. Okay. So, we said that we had income of 2.5 million. So in our Excel template, remember, everything is debit, credit, right? That's key. What that's about. Okay, debit, credit. So if we made money, that means we got to credit our payable, debit our provision. Okay, our dividends received deduction, that was a good perm. So that's a debit payable, credit provision. Stock options. Okay, here's the messy one, right? So, I don't remember the facts of the problem. Okay, so we had one award that was $100,000 of book expense this year, but no deduction. And then we had another award where the deduction was 50, but last year we expensed 75. Right? So, that means we're going to get an add back. So in this formula, there's 2 numbers. There's a credit to the payable of 100, because that's the book expense that we can't deduct. Okay, so that's going to increase our payable. It's a credit. Offsetting that is a deduction of 50, and that's a debit. That's a positive number. Because that 50 is going to give us a deduction. It's going to save us tax. When we save tax, our payable goes down. So when our payable goes down, we have to debit the payable. Okay? Okay, and then depreciation. Book depreciation was bigger than tax by 150, so that means our payable goes up because books was higher than tax, so the tax deduction is lower. Tax deduction is lower, that means there's more taxable income. More taxable income means higher payable. Higher payable means credit to the payable. Okay? All right. So our tax liability is 1052. That is our step 1, current liability. Our deferreds are easy. We didn't have any deferreds coming into the year. Right? In this example, we didn't have NOLs coming in. We didn't have stock option DTAs coming in because the stock options we had, we couldn't anticipate deductions. So we didn't have DTAs coming into this year. So the only DTA we have is the depreciation for the current year timing difference. That's pretty easy, right? We can't deduct that extra book expense now. We'll deduct it in the future, so the DTA builds. There's a debit to the DTA of 60. And the balancing entry is your provision. Okay, so the provision is 992. Easy. Alright, boom, man. 5 minutes on that one. Okay, so when you look at your rate rec, that 992, we had 2.5 million of income, so that would cause us to think that we have a 1 million provision. We got a good guy for the DRD of 40% of 70, which is 28. And then we had a bad guy of the 20,000 for ISOs. Okay, and the only reason that's slightly confusing is because there's 2 ISOs in there. There's one bad guy for 100,000 times 40%, and there's one good guy for 50,000 times 40%. So it's a net bad guy for 50 times 40%.
That was the 100.
100 of current year book expense we can't deduct. That's 100 bad guy. Bad perm. The 50 that we got a deduction for this year, it's all good perm because the 50 is less than the previous bad perm. Okay? All right, so in the problem, I think the question was, what if the same facts were true, but the current year ISO deduction is not 50, it's 120. Okay. Tejal, did you do that one?
Yes.
Of course you did. What was the answer?
Should I read out the journal entry or just the provision?
No, tell me what the provision answer is.
982,000.
982,000, is that what you said? 982,000. Okay, so before I even open the solutions, let's just kind of talk about that, see if that makes sense. So Tejal is saying it's 982,000. Okay, so if you envision this spreadsheet on this payable tab, if the deduction is 120, what's going to change? So don't ask me why I can't edit the schedule. Something's going nuts here. But this row is going to change, right? Okay. So let's talk about how that row is going to change. The payable. Right now, the payable is a credit of 50,000. Right? That number is credit of 50,000 because it's 100,000 bad guy and a 50 good guy. If it became 100 bad guy and a 120 good guy, that 50,000 is going to flip to a debit of 20. Right? Okay, so we got a debit of 20 in column B. So now we go over to our provision. So that provision right now is made up of 100 bad guy. And what's going to be our good guy if the deduction is 120 for the award? How much is the good guy, Brittany? 75. Right? Our good guy can only be as high as the prior expense. So that 50 of bad guy is now going to shrink to 25 of bad guy. Okay, so we got 25 of a debit in the provision column. We have a net bad guy, so that's a net debit. We got a net 20 in the payable column because we're saving tax of 20. Our 120 deduction is slightly bigger than our 100 of add back for the bad perm. So that means our balancing entry in column E is going to be a 45 credit to APIC. Right? And that makes perfect sense because the 120 of deduction exceeds the 75 of prior year book expense by 45. So we should credit APIC for 45 this year because that is an excess benefit. Looks just like that. Okay? All right, so the first class problem we did had just non-qualified awards, right? Where we were setting up DTAs, and then we were reversing DTAs. The second problem we did had only statutory awards where we weren't anticipating DTAs, and then we get a deduction in year 2, right? Okay, so the third problem we're going to do, I'm just going to hop right to it. We're on a roll. Okay, the third problem has both. Okay, so with the third problem, we have income of $1 million, we have meals and entertainment, we have depreciation, we have warranty. Like that stuff seems so easy now, right? That's what's great about level setting, right? Now we're kind of dealing with a different source of pain, so that other stuff seems really easy. Okay, now we have ESPP expense for the current year of 50. Separate from that, we had people having a disqualifying disposition from their ESPP of 35 when the prior bad perm was 60. We also had RSU expense this year of 75, and then we had an RSU deduction of 35 related to an award that last year had 50 of expense. Okay? Okay, so the facts are adding up. Assume we're still like away, and we have tons of APIC pool. All right, you got it? Okay, so here's the solution to problem 3. Okay, $1 million of income. Meals entertainment increases your payable. It's perm. Incentive options. Okay, there's two things going on in here. There's a $50,000 bad guy. Current year expense. I guess this is ESPP, even though we have it labeled ISOs. You get the idea. 50,000 bad guy. Current expense, we can't deduct it. We treat it as a perm. Can't anticipate a DTA, right? 35 is the current deduction for the award that last year we expensed something more than 35, like 60 or something. So we're going to book a good perm for 35. The lesser of the 35 or the 60. Right? That reduces our payable, so we debit our payable. So the net of those two things is a net increase to the payable. Depreciation, warranty, those are easy. Restricted stock. Okay, there's two things going on here. The first one is there's $75,000 of book expense. That book expense is creating a DTA because we're going to get a deduction next year. So that's increasing our payable. The second thing that we have going on is we have DTAs reversing for current year deductions. The deduction's 35. The payable reversal is 50. Sorry, the DTA reversal is 50. Okay, so in our DTA column, we got a plug formula, but if you thought about what those numbers do represent, forget the formula. It's a 75,000 DTA billed for the current year expense, offset by a 50,000 reversal for the DTA I had set up at the beginning of the year that has to go away. So a net 25 bill to my DTA, but there's two things going on there. If this is confusing, don't do it as one row. Do it as multiple rows. Some of you have already figured that out. But consistent with the theme I said like in the first class, make things into the smallest element you need to make them in order to get the thing to work. Okay? So don't net like this if this is confusing.
So what was that 40 that consisted of?
The 40 consists of a 75,000 add back, book expense that's not currently deductible, and 35 of current deductions related to an award that we thought we were going to get a 50 deduction for and had a DTA set up for that. And we have a debit to APIC of 15 because on that award that we got a deduction for this year, there's a shortfall of 15. We thought we were getting a deduction of 50, so the DTA went away for 50. The payable only changed by 35, so there must be an APIC debit of 15. We'll send you all these Excel files.
Before the weekend, right?
We'll send them to you tonight. No problem. Anna's pretty good about that, right? Okay. You let those numbers all kind of drop down. Boom, right? When we look at our rate rack, we had $1 million of income. We expected 400. Our perm for meals and entertainment of 10, and we have a perm for incentive options of 6. Okay, and if we said, well, what's that 6? Okay, that 6 is a bad perm for the current year book expense of 50. Okay, we had a bad perm this year of 50. And then we had a good perm this year of 35. So we have a net bad perm of 15, net increase in tax of 6, total provision of 416. Okay, if that's confusing, put the two ISOs or ESPPs, whatever they are, on two separate lines. Okay, put like the current year book expense, 50,000, bad guy, makes the provision go up by 20. Second ISO, we got a current year deduction of 35, it's all good perm. 35 rolls in at 40%, that's 14, 14 good guy. Okay, make them two separate rows, and if that helps you kind of process this thing better. Okay, so that's 3 problems. You ready for number 4? Okay, so we'll give you 2 choices. We can either go through problem number 4, we can even do it together if you want. I'll do it by hand and we can kind of struggle through it for those of you who want to go a little slower, because I know if you just look at the Excel schedule you're like, that's too easy, that doesn't make me feel better. All right. So we can go through problem 4 together, kind of sludge through it. Or there's more material in the slides about how stock compensation accounting works. If we go through that, that's totally fine. That stuff that we're going to cover is harder and a little more esoteric. So if you want to keep your mind wrapped around like the key themes and like the basic building blocks, we shouldn't go over that because it might melt away some of the stuff you've learned in the first 3 hours. The stuff that's in the slides around it's around APIC realization and footnote 82 accounts, if you know what those things are, if you ever heard of that. That's like paramount to what's in Amazon's 10K. So we can kind of touch on Amazon's 10K next week too. But that's where things get really hairy, when you start adding into that. Okay, so you want to do problem 4 or you want to talk about brain hemorrhage stuff? Problem 4, huh? What if I said the other stuff's going to be in the exam? Problem 4. Okay. So problem 4 has 2 parts. Do either one of you have a printout of the problem, by chance? I'll take yours. Or if you have one. Okay. Problem 4. Okay. All right, so problem number 4. Let's just figure it out together. And by the way, if you're like, this is so easy, I got this in the bag, and you want to go home, I'm totally fine with that. I'm just saying. I was hoping Anna was going to pack up her bag and just walk out right there. Okay. Judy Limited. Oh man, this is not even a teacher's aide that's getting a problem. This is just somebody, this is the guy sitting next to you in the office. Okay, so we have a company that's making $1 million. Okay, let's do our current calc first. I'm sure you notice how we just do the format totally differently when I write it by hand versus when I do it in Excel. You know, and we get to the same answer, right? So it's just more proof that if you looked at the Oracle provision model and then you picked up the Seagate model and you looked at the SanDisk model, they look totally different. I don't know even what any of the 3 look like, but I'm sure they look totally different. And that's just true. I mean, it seems like every company's provision is different from the next one's. Okay. PBT of $1 million. Meals and entertainment, we have to add back 35. Tax depreciation exceeds book by 150. Inventory reserves go up by 50. You notice here I don't do a debit credit either, huh? It's like everything is the opposite. Okay, so now we get into our stock comp stuff. Okay, so we're going to call this ISO 1. ISO 1, current year expense, 50 grand. We're going to add that back. Perm, right? ISO 2. So, Way, what do we do with ISO 2? Current year deduction of 100,000. Previous 123R expense of 60. If we're doing our current calc, what goes in our current calc? That's right, 100. Right? We're doing our taxable income calc, so we're going to take a deduction of 100. $60 of that is going to be a perm. 40 of it is going to be an APIC item. Right? Right. Okay. Current year RSUs. Let's call this RSU 1. RSU 1 is $35,000 of DTA. RSU 2 is a deduction of $40,000. Okay, so that one's tricky because this one's going to have an APIC shortfall. Alright, we'll get to that when we deal with the deferred schedule. But that one we had a DTA setup of 85, but we only got a $40,000 deduction. Okay, that's our taxable income. Calculator, solution, anyone? Still there? $880. That is what the solution says too. Okay, 880. 40%, so that is 352. Right? Okay, that's our payable. Alright. Philip caught me slacking off. Okay. So we have an R&D credit of $35,000 from last year, $25,000 from this year. So our tax, $60,292. You right? You satisfied now, Philip? All right. Okay, so that's our payable. So if we were going to map out a journal entry, let's just kind of start creating our journal entry for fun. We're going to credit our payable for $292, right? And we know that we're going to credit our APIC for that $40,000 excess benefit for that ISO. So we're going to credit APIC for 16. Okay? Did I do that right? 40,000. Yeah. I'll come back to the RSU in a minute. Say that again? APIC pool is 0. I know, all I was dealing with right there is just this guy. I was just dealing with this. That's a good guy to APIC. I haven't yet dealt with this guy yet. Okay? I'll deal with him in the deferred part. Okay, so my current is 292, and I know that I saved some current because of APIC benefits of 40 times 40%. Okay? So now let's do our deferred. Okay, so I have beginning of the year, current year change, shortfall, end of the year. Alright, so beginning of the year. Let's see, if I'm looking at this thing, the beginning of the year DTA should consist of RSU 1 for 85, and that's 85 times 40% is 34, and then Philip is on the ball, so he's going to tell us we have a 35 credit. So we had 69,000 of DTAs to start the year. Okay, so that is R&D credit right here. Dig? Okay, so in the current year, all kinds of stuff is happening. We got RSU 2, we got depreciation, we got inventory. Okay, so from a current year change perspective, this guy went down by 40. RSU, I think I mislabeled them. No, I got it right. No, I didn't. This should be 2. Hold on, let me get my labeling consistent so I'm not confusing you guys. So I said RSU 1 was the 35 add back for the current year. So I mislabeled these things. So if you're consistent with the current, this is actually 2 and that's 1. Okay, so for RSU 1, which is a current year book expense of 35, we build a DTA. For RSU 2, we already had a DTA from last year, now we're just reversing it. And so far we're just going to reverse it to the extent of the deduction. Depreciation is going to create a DTL because our tax depreciation exceeded book. And inventory reserve went up. Okay, so the sum of those guys, 105, right? I use my R&D credit. So my DTAs went down by 77 grand because of temp items. Okay? Remember, you're getting the solutions later, so just try to soak it up and follow the flow. Okay, so I have a shortfall column because I got this shortfall of 45 grand. So my ending deferred will go to 0. Alright? The rest of the deferreds just roll forward. I did something wrong. What did I do wrong? 150, 5100. Oh gosh. Okay, so I did my math totally wrong. Philip wasn't watching. Okay, so that 150 and 150 is 100. 100 minus 35 is 65. I got my signs going the wrong way. So 40% of 65 is 26. So that's 26. Okay? So now here's the tricky part. So this deferred goes down by 45. 45 times 40% is 18. So we know our deferred goes down by another 18. Right? Okay. So we know that that is going to be a credit to DTA for 18. Okay. And how much can we debit to APIC? 16. Why 16? Yeah, how much APIC pool did we have at the beginning of the year? 0. How much APIC pool did we get from the current calc? 16. So we have 16 of APIC pool, but we have an 18 shortfall. So I can debit APIC 16, but I actually have to debit provision 2. Right? Okay. So my total change in deferreds is going to be 95. Right? My deferreds go down by 95. So if I go to my journal entry, oh man, good for you guys. I emailed our guest speaker at break there, and after she was still coming. She's still coming. Good for us. Okay, we're going to credit our DTA for 95. And we said we're going to be able to debit APIC 16. Basically so we can wipe out that. Okay, so our provision is going to be the rest. 387. Okay. So now let's do a rate rec. There's a bunch of stuff going on in this one. The rate rec on this will not be easy. Okay, PBT of $1 million. I would expect a tax of $400,000. I said that I was going to end up with 387. So I need to figure out what is between point A and B, right? Okay, Sabrina, tell me one thing that is between 400 and the 387. Sabrina goes with the easy one. 35, 14. Okay. Connie, we need another reconciling item. Currently does not tie. Okay, you want to go with ISO 1. $50. Is that a good perm or bad perm? Bad perm. Tax expense goes up. Okay, Asmita, give us another reconciling item. We're currently getting colder here. We're going farther away. ISO 2. Okay, what's that? 60. Okay, so that's 24. Now we're going in the right direction. Okay. We tie? No. No. Now you're like tucked in behind Marianne. You've been sheltered tonight. Okay, we need another perm. We have at least 2 more. Okay, say that one more time. An RSU of 35,000. Maybe not. Okay, so with the RSU, this is fine. So the RSU of 35,000, that's current year book expense, but we're going to treat that as a timing difference, right? Because we set up a DTA for that. Right, so if you remember back on our deferred tab, we set up a DTA for the 35,000 right here. So that was us saying, no worries, right? If you look at our current calc, we added it back, but then when you look at our deferred tab, we showed a DTA, timing difference, right? Timing differences don't impact the rate. Okay, Philip. Smart guy that was watching me make mistakes. What else affects the rate? You're so smart. What's that? RSU2. See, that wasn't even the one I was guessing you were going to say. Yeah, Philip's smart aleck with the R&D credit, right? Okay, how much does the R&D credit rate benefit? There's a little bit of a trick in here. $25. Yeah, that's the tricky part, right? Is that it looks like we're getting 60 of credits. But remember, we had already set up 35 of DTAs at the beginning of the year. Right? We already benefited that carryover from last year. That was already sitting in our assets. We don't need to benefit that again. We just need to use it. Okay, so we got 414, 434. 434 minus 24 is 410. 410 minus 25 is 385. Oh man, we're so close. Megan, what do you think the difference is? RSU, say that one more time. Reversing the APIC portion. Okay, I think what you're saying is this. Yeesh, what just happened? That too, right? We had a shortfall in our RSU that because we ran out of APIC pool, we had a provision expense. Right? So RSU2 shortfall, we had a $2,000 increase in our provision. Oops.
So what you call shortfall is...
Oh, you gotta be kidding me. Now that's bad timing. Okay, so you guys can just squint. Pretend there's one less zero on that line called RSU2 shortfall. And voila, the rate rec works before we shut the program down. Okay? Even the software can't even handle this thing. It's so smoking, huh? Yeah, Jose. What you do with the extra 2,000? Well, if I could just show you this entry that we had here, we're gonna lose everything too. Oh well. Stupid PowerPoint. Yeah. Okay. You don't want to look at that. All right. That's not going to solve your problems. So, oh, it saved it, most of it, actually. How about that? Okay, the 2000, that was that missing link in the rate rec, is this. No, it's 387. So what we need here is a shortfall of 2. And now if you did this math, the 387 would work. But the moral of the story is our provision is 2,000 higher than it really should be. Our provision went up because we had a temporary difference from this RSU, but we never got the deduction from that temp item. And we had to write off some of our DTA to expense. Right? It's almost like if you set up a NOL DTA and the NOL expired. It just went away. You'd have to write that NOL off to your provision. And that's basically what happened here. Like, we set up a DTA for 85. We're like, we're going to get a deduction for 85. We didn't get a deduction for 85, so we had to write off the deferred. And when we had to write it off, we had to expense it. And luckily, we got to send most of it to APIC, but some had to hit the P&L.
So that's the same as excess.
It's a shortfall. Okay, so that's year 1 of problem 4. There's a second year. You can do that too. We're no shortage of problems tonight. Okay. The ISO deduction of 60,000. Yep. Why is that not 100? Okay. So let's go back to the problem. Okay, so the question is, for the ISO deduction, why are we taking the 60 instead of the 100? Remember that our good perm, and perms affect the effective tax rate, is the lesser of the deduction or the prior book expense. So the lesser of 60 or 100 is a perm. And any excess, any deduction above those two, goes to APIC, doesn't affect your provision. Okay? So the journal entry for just that, if you were doing a journal entry for just that award, we would debit the payable for 40, because that's 100 times 40%. We would credit the provision for 24, which is 60. Oops. Let's slide our screen over here. 60 times 40%. This is 100 times 40%. And the excess would go to APIC. So the only thing that's going to drive your rate rec is the item that you actually hit the provision. So when we did a rate rec item of 60, it was because the only thing that's driving the provision is the 60, not the 100. Right? When we do a rate rec, we're reconciling the provision. We're not reconciling the payable, the provision. Okay, so the way to learn this stuff, man, just to keep doing problems. The reason we do so many problems tonight is because this is the way you learn this stuff. Okay? If we could do an 8-hour class, I would just keep going. Alright, just more problems. Can I go what? Back up a slide? If you want, I can save this file and we can send it to you, but I don't know. It's pretty helter-skelter.
It's the same as the Excel.
The Excel is much cleaner, a little easier to follow if you ask me. Okay, here we go. So I skipped over a bunch of slides because remember I said we had some esoteric stuff in there? So we'll go through that next week. All right? So here's what I would do if I were you. I know you guys are like abysmal when it comes to reading. But now that I've explained all that stock comp stuff, if you go back and read that roadmap thing, that Deloitte book on 123-hour stock compensation, I swear it'll make sense. Because you'll have heard it before, and what I said maybe made some sense. So when you then read it, you might be able to connect the dots between what you read and what I said. Okay? It will make more sense, I think, reading it now after hearing it. So if I were you, especially if you're struggling, I would read it.
I mean, I read the 123-hour roadmap and then the ones 10.1 through 30.
Yeah, read it again.
But they're basically the same.
I know.
Okay.
If you haven't figured it out, one of the approaches in the class is repetition. Right? Yeah. Okay. So we didn't finish in class exercise 4. Finish it. Okay. Do year 2. It's not that hard. We did a ton of these problems, right? Prove to yourself you can do this without me kind of telling you what the answer is. You know, when you do the exam and you got to do the problem without me telling you what the solution is, it's just different, right? You got to figure out how to do it yourselves. Okay, bullet 3. So Wendy Lee's coming next week. So Wendy is the tax director that's in charge of the provision for Salesforce. Salesforce is a pretty cool company, so they're up in the city. So Wendy's actually going to come hang out in our office next Tuesday and then come over with me. So they all live in the city, and so she can explain life in the city and talk about their provision. Their provision is pretty wild. So when you read their 10K, it may not make a lot of sense. They have gobs of stock compensation issues, really, really thorny ones. So see if you can figure something out and ask some interesting questions. Okay, so I want you're going to just cringe. I want you to write a 2-page memo. Okay? Pretend you're a staff person at a firm, and she's the CFO. Okay? Send the CFO a memo in 2 pages or less that explains their provision. Okay? Accountants suck at words. So I want you to use words, and pretend you're writing to a CFO, right? A CFO wants like a crisp, concise, quick understanding of what's going on. Like, don't babble on, right? Just say the important things and say them quickly, right? When I was interviewing last week down at Cal Poly, I was telling the students, I'm like, of your resume, I look at it for like 7 seconds. You know, I can look at it so quick. And that's what this needs to be for the CFO. You know, I want it to be quick so the CFO could pick it up and read it really quick. What's my rate? Why is it high? Why is it low? Why is it different from last year? What's on my balance sheet? Right? Give me the quick snapshot. Like, don't write me a novel. Write me like the quick Cliff Notes version. Right? Pretend I only have an elevator ride till I get off and I have to explain it to somebody else. All right? That's how it works. Okay? So write something that's easy to understand and that a CFO type could pick up the headlines of what's going on with Salesforce's provision. For all I know, the CFO would love to have it explained to them. Okay? It's complicated. Okay. So I want you to read the Salesforce 10K. I want you to come with questions. So just like we did for Lee, I'll have Wendy tell you about her career and all that, but then we can talk about the company and their provision, that sort of thing. Okay. And then class 6, we're going to just review for the exam. So we're going to cover all of classes 1 through 5 again in terms of the highlights, and you guys should come with the things that don't make sense to you so you can ask questions. What about Amazon? We'll try to cover Amazon next week, or we can stay for another hour if you want. Okay.
But were we still supposed to try to highlight it?
Just hold on to your highlights.
Okay.
Yeah. But yeah, Amazon and Salesforce, you know, these are great examples of where you take the stock option stuff we learned tonight and you just put it on massive amounts of steroids, and that's what their provisions are. They just have major stock option issues. Yeah. Okay, so Anna's actually going to teach a bunch of Class 6 too. So If you have questions you want her to cover in class 6, send her an email before class because we can kind of tailor it to what you guys want to cover. But for the most part, it's reviewing to help you get ready for the exam. And I know this class usually tends to be really overwhelming, and so we'll kind of let you absorb it, and we'll cover it again next week a little bit too. All right? Okay, see you guys later. Talk to you later. Have a good night.
Oh, yeah.